Hello, and welcome to another episode of Getting Your Shit Together. I'm your host, Neil, and today's episode is dropping right after a major move, or should I say, a non move by the Bank of Canada. The Bank of Canada just hit a pause on rate cuts after seven consecutive cuts, keeping the prime rate unchanged at 4.95%. Now, you might be wondering, is this the end of the rate cut party or just an intermission? Today, we are digging into what this pause really means for your mortgage, your strategy, and whether the dream of lower payments is still alive. Plus, we will touch on what to expect for the rest of 2025. So, let's get to it. So, here is the headline. Prime rate remains at 4.95%. That's after Bank of Canada held its overnight rate steady at 2.75% or two and three quarters. It's a full two and a quarter drop from where we were last summer. That means if you got a variable rate mortgage or a home equity line of credit or anything that is linked to prime, you have already seen some nice savings. Since June of 2024, your interest costs have dropped by about $188 for every $100,000 of debt you have. But why the pause and now? Let's look at what's happening to maybe understand the reason behind this pause. Canada just barely avoided the US tariffs thanks to a 90-day reprieve, which is temporary in nature. Still, our aluminium, auto, and the steel sectors are bearing the brunt of the tariffs. Markets in general are shaky. Stocks dipped towards bear territory before recovering. Bond markets have also been swinging like a pendulum, and the US economic confidence is sliding. On the home front, job losses, cooling economy, and slowing wage growth are creating some cracks. Oh, and Canada's federal election is just around the corner. Mark your calendars, 28th of April. So, political uncertainty. And add to that, the carbon tax cut to 0%, at least. It's not cancelled, it's just cut. A cooling housing market and a February CPI at 2.6%. And you might get why the Bank of Canada just wants to, well, take a breath. So, this is what is happening with mortgage rates right now. And let's get a feel for what the bond yields are doing to start with, because they tend to lead the way for the fixed rate mortgages. Over the past month, the 5 year bond yields have been all over the place. From a low of about 2.4% on the 3rd of April to a bounce to about 2.9% just a few days later. As of now, we're sitting about 2.7172%, slightly higher than where we were in March. And you might ask, why does it matter? Well, because most lenders reacted fast, bumping fixed rates by about 10 to 20 basis points higher. It's a good reminder that bond volatility doesn't just impact investors, it hits home buyers, homeowners, and anybody looking to get some credit. And here is a kicker: the recent high of 2.73% was breached. So, unless the downtrend kicks back in, we might have already seen the near term bottom in bond yields, and by extension, fixed rate mortgages as well. So, here is a big question again: whether you should go fixed or variable. And so, let's talk some strategy. Fixed rates have been lower than the variable rate counterparts for a while now, and the gap is shrinking and almost eliminated as of this moment. If Bank of Canada resumes cuts later this year, variable rates could finally dip below the fixed rates again. But here is a catch. Lenders have been quietly reducing the discounts on the new variable rate mortgages. And again, this trend which started in October 2024 and continues till date. So if prime drops, you might not get the full benefit as the new borrower. So what should you do? Well, generally speaking, if you want stability, you should go fixed rate. Maybe choose a shorter term, like a 3-year term, which gives you flexibility to act when rates fall further, if they do. If you're comfortable with risk, variable rate mortgage could pay off because we are still probably looking at some more cuts this year. But if you're torn, maybe consider a hybrid mortgage. It's part fixed, part variable. It's like having a seatbelt and a parachute. The bottom line is there is no one size fits all answer. It all comes down to your risk tolerance, your financial plan, and how long you expect to be in your current mortgage or home. So, what's next? Are more cuts coming? Or this is as low as we go? According to the bond market and the big bank economists, we might still see another 1 to 2 rate cuts, maybe even three by the end of the year. But here's what could shake things up. Maybe a US or a global economic slowdown, inflation roaring back unexpectedly, political or geopolitical chaos, and a wild card. If investors start losing faith in the US economy or the US dollar, they might start dumping US bonds. And that could take the Canadian bonds yield as well for a ride. So I believe Bank of Canada may not be done yet, but we are definitely closer to the bottom than we were a year ago. So there you have it. Prime holds at 4.95%. Fixed rates might be bottoming. Variable rates could have still room to fall, but with tighter discounts. And the best strategy, well, that depends on what you want. If you haven't already, check out my full blog post. You can find the link in the description. And we have also included charts for the number crunchers out there. As usual, if you have any questions about your mortgage renewal, your upcoming purchase, or whether it's time to switch strategies, reach out. DM me, email me, or book a meeting with me. I would love to help you make sense of all of it. And hey, if you found this episode helpful, do me a favor. Share it with someone who's maybe hunting for a mortgage. Leave a review if you liked what you heard, and hit that subscribe button to stay connected. Well, until next time, keep your finances sharp and your shit together. Catch you soon.